the end. So thank you all for joining this morning. It's a pleasure to be able to speak to you. As Dave probably mentioned, I've had a lot of experience with startups. I've invested in over 100 companies, and cash flow and finance is very important. So that's the subject that we want to talk about this morning. And I like to say happiness is positive cash flow, because if you have lots of cash flow, you'll always be happy and never worried. So just want to say a word about reporting versus forecasting. Many of you who have been in business for more than just a few months will, of course, be familiar with reporting. And there are a lot of excellent programs that you can use, like QuickBooks and Xero and many others that let you report. And when you do that, of course, you let your investors know how you're doing, and you often compare your progress against what you predict or forecast will happen. So as an example, or just before I give you the example, the question that I'm asked a lot as an angel investor is why companies fail. And there's basically one reason, and that's because they run out of money. Because if you have enough money, you can always do a restart or a pivot or replace management or do all kinds of things. But it usually comes down to mismanagement of cash flow. So hopefully after today, at least you'll know where you stand cash flow wise. So here's the example that I was just referring to. And this is I took this from one of the companies that I'm involved in without editing it or making any changes to it. And you can see that the most recent month is shown first with October, and there's a column for actual results and another one for budget or planned results. And this is a good thing to do to keep investors informed. It's a good thing for you as part of the management of the company to know exactly how you're doing compared to what you hoped you would do. But the key question is, well, what is it that you plan to do? And that's the main subject today. Now, when we talk about cash flow, you know that there are several statements that are often presented when a company does its financial reporting. You have the P&L, the profit and loss statement, which is also referred to as the income statement. You have a balance sheet, and quite often there is a statement called a cash flow statement. And that basically shows what's happened cash-wise during the reporting period. And that's quite different from a cash flow projection. So, for instance, here's a historical cash flow statement, and it just shows what happened to cash and the changes from the beginning of the year to the end of the year. And you can see that this can be broken down into operating activities, investing activities, financing activities, and so on. And you can see the increase or decrease in cash. And this is often a statement that will be included in your annual reports. But what we want to talk about this morning is how you do a cash flow forecast. And it's really a question about what will happen in the future. So what we have here, and this is an example from a spreadsheet, and I will be more than happy to share this spreadsheet with you, and I'll give you a link later on where you can access this, and you can play around with it and use it to model your own company. But what we have here is a month-by-month cash flow, and it shows cash balances using income statement projections. The question is, what's the cash on hand in the future going forward? One way to look at it is what is in your bank account? What is the bank balance? Because that's where you go to make your deposits and your withdrawals, and you want to make sure that that is always a positive and hopefully very large number. A question that investors always ask is, what is the burn rate? We can have a net or a gross burn rate. You've got a basic burn rate, which is just your fixed costs, your overhead, and so on. And then that can be hopefully reduced once you have revenues rolling in. But the key question is usually around revenue, because that's the one thing that's not overly predictable. You can plan for it and you can do certain things to count on getting certain revenues. But the bottom line is that revenues are controlled really by your customers and how well you serve them and how effectively you sell to those customers. Another question is, can all your obligations be met? And by that, I mean, can you pay all of your suppliers? Because if you can't, they can petition you into bankruptcy and shut you down, even though you may have a very rosy outlook and, in fact, even be very profitable. I have seen many very profitable companies fail because of cash flow mismanagement. So, just back up here, I think I skipped one. Okay, the best tool to use for this purpose is a good old spreadsheet, like the very popular Microsoft Excel file. And I like it because it helps you understand your numbers. And you can customize it to suit your particular specific business needs. But because you create the spreadsheet from scratch, you'll be intimately familiar with what's going on in your company, financially speaking. So when we're doing a cash flow spreadsheet, we first of all start with the profit and loss projections. And I'll walk you through that in a moment. And then we're going to look at assumptions around accruals. And for those of you who aren't familiar with the term accrual, what we're talking about here is accounting for liabilities and assets when they occur. So for example, if you sell something to a customer and you give the customer 30 days to pay, you accrue for that by saying, okay, we've made a sale and we now have a receivable coming in from a customer. But that receivable will show up on the balance sheet as just that. It'll show up as an asset, but it's not cash. And ultimately, you need to turn that receivable into cash. So you have all these accruals taking place. Similarly, when you purchase something, you don't necessarily have to pay for it immediately. You may be given 30 days or a couple of months to pay for it. So it becomes a liability and you have to accrue for that. And when we talk about cash flow, we have to turn all of those accruals into cash based on certain assumptions. And it's all about figuring out what the month-end cash balances are going to be. The file that I'll make available to you is called finproj.xls, and you'll be able to download that from my website, mikevolker.com. So here's an example monthly income statement or profit and loss forecast. You can see at the very top that I've got a section for sales. And of course, sales drives everything. So what I've done here is, just by way of background, shown that in this particular company, which I've called Millennium Tech Corp, we have a certain number of dealers that we expect to sign up each month. We, after discussions with those dealers, we get numbers from them in terms of how many units they can sell each month. That gives us dealer sales. We also have a website for selling our products. We call that direct sales. So we have total unit sales on a month-by-month basis. We have determined an average selling price, and you can see that's decreasing a little bit over time because we figure as time goes on, we'll be able to drop our price a little bit. Then on our next line, we have gross revenue, which is simply the total units times the average selling price. So you can see in this example, we start off with $11,200 of sales in our first month. And this increases up to more than $250,000 by month 12. On the very right, we've got our annual total, which for the first year in this example is just over $2 million. Then underneath our gross revenue line, we show our unit costs. And by multiplying the unit costs by our total number of units, we get our cost of goods sold, often referred to as COGS. And you'll hear that terminology quite often. We can also then calculate a gross margin, which in this example is actually not great. 31% is not a fantastic gross margin, but let's see what happens. This could be a business which does a lot of manufacturing and does not necessarily have a lucrative gross margin, as you might enjoy with software, just as an example. Then we have our fixed expenses. We have a line for sales, a line for R&D, and a line for general and administration. This gives us our total expenses, which when subtracted from our gross margin, gives us our net profit before taxes. You can see in the first month that that is negative 7,000. Not good, but in the startup, that's very typical. In this particular startup, we turn a profit quite early on. In fact, in month 3, you can see we're starting to generate a profit, at least on paper, not necessarily cash in the bank, but on paper, we're starting to generate a profit. By the time we get to month 12, that profit increases to $47,000, which is 15% of our revenue. Not bad. For a total annual net profit, or for our first year, of just under $300,000. So if I look at this as an investor, for example, for a startup, I say, yeah, this is interesting. This is pretty good. If you can get up to $2 million in your first year and show a little bit of a profit, that's great. Of course, I'm also interested in what this might look like in 4 or 5 years. Is this going to be a $10 million business or a $100 million business? Angel investors especially are very interested in knowing that. So again, remind you about the difference between cash and accrual. Now, that statement we just looked at says absolutely nothing about cash. We have no idea what's happening to our bank account. These revenues that we're showing, are they turning into cash? And if so, when? Same thing with our suppliers. And as I mentioned, our suppliers, and especially our employees, will not necessarily wait to be paid if we don't have the cash to look after them. So here's a sample monthly cash flow, and this comes directly from that income statement that I just went over with you. And I produce this by making certain assumptions. In this case, I've gotten 2 different sets of assumptions. So what you see in the top here that I've referred to as cash flow number 1 is based on me paying for my production materials in the month of shipment. So in other words, when I ship the goods to my customers, in that month, I have to pay my suppliers for the goods that I receive from them. I'm also going to assume that my customers are not going to pay me in the month that I'm shipping product to them, but rather they're going to provide checks to me in the following month after shipment. Then I've done another set of assumptions. In this case, I'm paying for production materials 2 months before I ship the goods. That's a more conservative assumption. It allows me, for example, to do quality control or assembly or testing on the goods before shipping them. I'm also making the assumption that my customers are not going to pay me in the following month, but some of them may stretch their payments out 45 or 60 days, which is not unusual. So when you look at these 2 different scenarios, in the first one at the top, you'll see that my most negative cash balance is $106,000 in month 7. Now, this is great if my bank manager lets me do this. But we all know that they won't, unless, of course, we've negotiated a line of credit. So this tells me that right up front, I've got a problem. I know that I'm going to be short $106,000 in 7 months based on the assumptions I've made. In the second scenario, cash flow number 2, my most negative cash flow month is going to be month number 10. And it's 7 times worse than the other example. In fact, this shows that my most negative cash flow is $750,000 at the end of month number 10. And that's quite a difference based on just minor changes in those assumptions. So, which is correct? And if I'm a startup entrepreneur, what am I going to tell my investors? How much capital am I going to ask angel investors for? Of course, it's better to ask for a little too much than too little, but this is quite a range. Oh, little delay here. Forgive me for this little glitch here. So 106,000 would probably be pretty easy to raise. In fact, you can probably borrow that from family, friends, relatives, or on your credit cards. $721,000, on the other hand, may be out of reach. It may even be a little bit high in terms of going to angel investors. The average last year for initial seed rounds of angel investment was around $600,000. So 700,000 would certainly not be a stretch, and you could probably get that from angel investors. And if you can get it, great. But what is really the right number? Then we also have capital expenses to think about. And I haven't included any capital expenses just yet, because you can take things like equipment, machinery, and property and perhaps finance them separately. You could lease them, for instance, instead of purchasing them. But whether you lease or purchase them, ultimately, you have to include that on the spreadsheet. But I've started off a step at a time, and then you can add or modify as we go along. So my example so far excludes capital expenditures and includes only those sort of ongoing expenses, such as monthly rent and utilities, monthly salaries, and minor general and administrative supplies. Now, when you get into things like capital items, the accounting gets a little bit more complicated because you have to deal with things like amortization, and you can budget the purchase for capital equipment items, but then of course you have to, on your P&L, start amortizing those devices over their useful lifetime. CapEx items, of course, will show up as assets on your balance sheet. And the interesting thing is, with my model, if you start to put CapEx items on your income statement and on your cash flow, I should say, it's actually very simple then to start producing balance sheets, either month-end balance sheets or year-end balance sheets. So how do we add these CapEx items? It's as simple as just adding a few more rows to your cash flow. So what I've done here is, you can see at the top, I've got my cash flow number 1 scenario from the previous slides. I've added additional rows to cover fixed assets. So here I'm showing that I'm going to buy some equipment, some furniture, some tooling, molds, intellectual property, and so on in month number 1, because I need these things in order to get my business going. those particular fixed assets add up to about $120,000. But for now, I'm just putting them in my cash flow to remind me that I've got to come up with $120,000 to purchase those items. I may be able to finance them, but then matching my sources of capital with my uses of capital becomes another exercise. Right now, all we need is the visibility. So I've included those, and then I've modified my cash flow number one, as you can see, so that instead of needing $7,000 at the beginning of month number one, I actually need $127,000 at the beginning of month number one. You can also see under the fixed assets that I have added some additional requirements. In month number three, I show tooling and molds requiring an additional $10,000. So I just include that and then, of course, modify my cash flow number one to take into account those additional capital expenditure items. Now, once you've done this, I mentioned making different assumptions. You can make all kinds of assumption changes. You can, for example, ask the question, what if revenues don't materialize? What if I only hit half of the revenues? What will that do to my cash flow? What if I've been a bit off on my expenses? What if, in fact, my expenses double? How is that going to affect my cash flow? And you can just pop these things in and play to your heart's content with the spreadsheet once you've got that set up. The question that I'm often asked is, for how many months should I do a cash flow? Well, at the very minimum, you want to do a monthly cash flow until your cash flow turns positive. Now, unless you are scaling up very dramatically with the proverbial very steep hockey stick curve, your cash flow at some point is going to turn positive. However, if your sales are right out of this world and so stellar, you're going to have to keep doing a monthly cash flow for perhaps several years. And you need to do that because it's always going to tell you when you need to raise more capital. For presentations, for example, to angel investors, it's a good idea to go out for about 5 years, at least on your P&L, and that gives the investor some indication of how lucrative your business will be and whether or not they want to invest in it. So I've extended my P&L spreadsheet, and I can show you here the results of that. So I've got the first year, which I went over with you briefly, and then I've extrapolated out to get following years. And I may or may not do this monthly. It sort of depends on my business. Ideally, I would do it monthly, but after the first 2 or 3 years, especially if you're a startup, there's a lot of guesswork, and it may be just as easy to apply some multiples to your first year results in order to get your second, third, fourth, and fifth year results. And when you download my model here, you'll be able to see what I put into the various cells to get my numbers for subsequent years. So here I show that this company can grow from 2 million to 12 million in 5 years, and profits will grow from 300,000 to 4 million. So is that good? Here I show those results graphically. Now, when an investor sees this, it will show them that, yeah, this business has reasonable potential. Getting to $12 million in 5 years, especially if there's profitability, is okay. It's not perhaps something that's going to be a unicorn, but it's still worth a second look. And if I see a company like this, I say to myself, well, this looks reasonable, looks profitable, it's doable. So let me have an additional meeting with the entrepreneur. Let's drill a little bit deeper. let's actually tear apart that cash flow and P&L projection and take a look at whether this really is possible or not. So whether it's good or not, to answer that question, depends a little bit. You can actually use this to drive exit valuation, because another question that angel investors often ask is, what's the company worth in 5 or 10 years from now? We're negotiating today a pre-money valuation based on virtually no track record and no results, but what could the business be worth down the road? And your pro formas will very much help investors understand exit valuation for your company. It also answers the question of, is it achievable or is it realistic? And for you personally, I would suggest, does it make sense for you to commit your life, or at least the next 5 years of your life, to this venture? Is it attractive enough? I see lots of presentations from entrepreneurs that show companies peaking in sales at $2 or $3 million in 5 or 10 years. And to me, that is more of a lifestyle business and not necessarily something that angel investors, or any investors for that matter, will be interested in. So it's very important for you to not only think about what angel investors will find attractive, but what do you want to accomplish? Will it make sense for you to work hard at this venture? And those numbers will help you determine that. Now, as a bonus from doing all this number crunching, and I have to confess that at times it can be very tedious, very boring, and not particularly exciting, but it does give you an intimate understanding of your business and what's happening financially. But the bonus from doing this cash flow exercise, and if you use the template, you will be able to do month-end balance sheets and reliable pro forma income statements on a month-by-month basis or year-by-year basis, and it'll be very simple. You'll be able to do it, and you will not need an accountant to do it for you. It'd be great to use your accountant to discuss it with you, but you will not need to turn it over to someone, because it'll be you that's in charge and in control of your future. A few sanity checks or double checks that you might want to think about are, do your revenues seem unrealistically high? I sometimes see projections that get to 50 million or more than 100 million in 5 years. While that is possible, it's unusual. So you may check with your peers or with others and look at other startups and say, am I an outlier? Hopefully you are, but you should know whether you're going to be treated with respect, or are people going to look at you and be a little bit skeptical because you may come across naive, for example. You'd want to compare your margins to those of other firms and see if you're, again, sort of in the ballpark or not. Have you overlooked any expenses? Have you built in some contingencies? Pad some of your expenses, for example. Allow for a few unforeseen things that you may not have thought about. Do you have a sales plan? Have you actually figured out step by step how you're going to build up your sales? Or are you just simply forecasting without a lot of basis behind that forecast? And again, very important, especially when it comes to your cash flow, are your assumptions reasonable? And my very last slide before we get to Q&A, using the Excel can give you a hands-on financial understanding of your company And from there, you can get the financial statements that you need going forward. You can test your assumptions, do worst case and best case. Having a spreadsheet like this will, I believe, be very attractive for investors or useful to investors, because investors really do like to see solid financial planning. It's an area of business presentations that usually is neglected. There are many times when I go to our monthly angel meetings, for example, where an investor will make a presentation, and there'll always be a few people in the audience that ask tough financial questions. And when you struggle as the presenter to answer those questions, it's a big turnoff for many investors. And then finally, remember, cash flow is paramount. And if you've got positive cash flow, if you have positive cash flow, you should be happy all of the time. And with that, I think we'll turn it over to some Q&A. I know I went through that a little bit quickly, and I did that because, you know, I could spend a lot of time with you going cell by cell and row and column by column on the spreadsheet, but it'd be better for you to actually do that. So I've given you just sort of a high-level picture here of how you can put that together. And when you actually start to work with the model, it'll start to make sense for you, and you can see what I've done to go from the P&L to the cash flow, and then from the cash flow to the balance sheet. So, time for questions.
Hello, this is Dave. I've just come back to join Mike. There is a Q&A function on the website, so if you're interested in asking questions, we'd encourage everybody to use the Q&A function so that we can take a look at all the different questions that come up. I'll start with one of my own, Mike. Something that I've always found important is that it's really, I like to be able to understand how you got the numbers right from the very beginning. I don't like to look at the big graph that shows everything being a great picture. I like to know what the inputs were right from the outset. And I think you showed that to everybody, but maybe you could comment on how important that is for an angel or a potential investor to look at a company. Does it really make a difference if you can't figure out how people got their revenue projection?
Yeah, so really it's all about the revenue projection, right, Dave? Because on the expense side, you're in total control of what you spend, and you can be within, 90% accurate on your expenses, because that's just really up to you. You may miss something, or you may get a bargain somewhere, but it's really up to you. But when it comes to revenue, that is the toughest part. Now, I can tell you from when I had my own computer terminals company back many years ago, the way we did it was we built up our revenue projections by talking to our customers. And in my case, we used dealers and distributors. And we would get estimates from them as to what they thought that they could sell to their customers. And then we took those estimates and we modified them somewhat. We knew that some of our dealers and distributors were perhaps overly ambitious, so we watered down their projections a little bit to come up with what we thought were reasonable numbers. What I can tell you is that the hardest part of it was for the first year. After the first year, it becomes simpler and simpler, because now you've got some history. You know who can deliver, i.e. you know which distributors and dealers can perform and which ones can't. So we had the benefit of starting to get traction and results from our channels of distribution. And when we did our projections, say in our second and third year, we went from maybe being 50% off to being only about 10% off. And after doing it 4 or 5 years in a row, our projections for the following years started to become very accurate because we had real history and real results. But getting started is the toughest part. And if you're doing something that, like for example, an app that you're going to promote through internet marketing, it's extremely difficult to know what those sales could be. You could do some test marketing. You could take a look at your potential market. You know, you've all heard of TAM, SOM, and so on, and you can get some rough ideas. But that's the tough part, and there's no panacea for that. You just have to start with your customers and say, who are the customers that are going to pay me for my products or services, and work back from them. Figure out how you're going to get to them and come up with some preliminary numbers. So at the outset, after you turn on the switch and have a few months behind you, if you are way off on your numbers, then of course you want to redo and update your projections, because you're probably going to run into difficulty cash flow wise if you've been way below your estimated sales in the future.
So Mike, we've got some other questions. I think I'll read a few for you. First one we have is from David Hewer. So how many scenarios do you usually look for when somebody's doing a couple of scenarios?
Well, I would say at a very minimum, you've got a worst case and a best case and something in the middle, something that you feel is comfortable that can be achieved. And the worst case is really good because it'll be most negative in terms of your cash requirements. And you know that if you're heading down that path, that you may need to raise additional capital. So it gives you a range of possibilities, and you need to have these different scenarios nailed down before you start your venture, because the worst thing that can happen is running out of cash. As I mentioned at the beginning, that's really the only thing that can kill your business, just not planning for that.
So another question from Mehdi Masumi, how do we estimate the exit value at the early stage of the startup?
Yeah, so if you take a look at the 5-year projections, let's say, and in the example that I gave you today, I showed sales of $12 million in year 5. Now, let's say that that's a medical device company. And let's say that a number of medical device companies have been acquired recently, and the value given to those medical device companies has been, I'll just pick a number, maybe way off for medical devices, but let's say it's 3 times the annual revenues. That would tell you that my particular company with 12 million could be worth $36 million in 5 years. Another multiple might be based on profitability. You may look at other comparable companies that have been sold and say, well, maybe they're going for 10 times or 15 times profit. And that would give you another data point. You might average those 2 numbers to come up with a value, but at least it gives you kind of a starting point. And I can tell you that certainly investors will do that. When I look at a startup, my question is not only what's it worth today or what can we negotiate today, but what is it going to be worth down the road? And what is the company going to be sold for, and what's my share of that? Because I want to make sure that I get a decent return on my investment. And having those numbers give you even just a rough idea on what those exit values might be. And that's how you determine them, by looking at comparables.
So we've got a few more questions. I'm going to go to one from John Garrison and say, in addition to using Excel, what type of accounting software do you find appropriate for startups? Is it Quicken, Xero, FreshBooks, QuickBooks? Which one do you prefer, if there is such a thing?
Well, I actually use most of them, and I have to be familiar with most of them because the different companies that I work with all use different programs. I'm probably the most familiar with QuickBooks, so I like it. But they're all quite similar. The ones that are available as SaaS offerings are great because you can easily communicate with your accountant or auditor because they can access, you don't have to worry about transferring files back and forth. It's all cloud-based. You, your bookkeeper, your accountant, other employees can use it. So, QuickBooks, Xero, FreshBooks are all pretty decent. And then, of course, it depends a little bit on what kind of a business you're running. You may find that if you're manufacturing, for example, then inventory and inventory control systems become very important, and maybe a basic accounting program will not do the trick. You might need something a lot more sophisticated. But there's certainly lots of tools available. I have not found a lot of tools that help you forecast and look into the future. That is where I think the good old spreadsheet still plays a vital role.
Okay, a couple of other questions. One from Edward Chang. So going back to the $100,000 or $700,000 amount that you're requesting from an investor, do we ask investors for the highest monthly cost that's projected before we include the projected revenue? I think the question is, are you just trying to cover the cost?
Well, okay, so in my example, we're manufacturing product. And so we're buying inventory and we're turning around that inventory and selling it to our customers. So a lot of our cash requirements are for that inventory. Now, you could assume, for instance, and it's a good thing to do, and I would suggest you start off with zero revenue and just say, okay, let's suppose that we've got no revenue coming in at all. Then what's our monthly burn rate? And is it kind of steady or is it increasing over time? And let's, for example, say at the end of year one, how much cash, how much negative cash is there if you run that spreadsheet? In other words, how much cash do we need to operate for one full year with zero revenue? Now, that might be a minimum that you would start with for investors. Now, if your business is software, then your cost of goods and materials used in supplying the product are very minimal. In fact, there's virtually zero expenditures required in delivering software to your customers. So your cost of goods is, and your margin is probably close to 100%. So for software, it becomes much easier. And all you really need to know is what your burn rate is and how much cash do you have before you run out of cash. But in the case of any kind of manufacturing, that's where it gets a lot trickier. And that's where, as I mentioned, you can actually run out of cash, even though you're showing very good profitability. And that's because of the accrual versus cash system of accounting.
So question from Michelle Vincenti, really as an angel investor. So what's your yearly return are you looking for when you invest, or how many years do you like to have for an exit strategy?
Yeah, so, and I'm just speaking personally here, my average is around 8 years. Now, some companies can produce exits in under 5 years, and I think that's great. But more often than not, I'm seeing companies take 10 years and longer to reach exits. Now, it's a very personal thing, especially as you get older in years, as I am. If I have to wait more than 10 years for an exit, I'm going to be in my 80s, and I'm going to look at that kind of an investment maybe a little bit differently than one that can produce a return in 5 years. So it becomes a very personal thing, but I can certainly tell you that on average, we hear of a lot of success stories, and we hear the term overnight success. I have yet to see many overnight successes. Most so-called overnight successes is just, they appear that way because we don't hear about them until they're successful, and then it looks like they've done it quite quickly. But in fact, it takes a while to build a very successful company, and investors don't really mind waiting. In fact, angel investors especially can be very patient. What's important is that you communicate to them some ideas, some of your ideas about when an exit might happen. And then the investor can take that into account when making an investment decision. Presently, a lot of my investments are through my angel fund called What If Capital. So I don't mind making an investment that's long term. I've got one investment that's been already 15 years, and that particular investment is still not generating any revenue. So they've been funded entirely by angels initially, and institutional venture capitalists subsequently. And I still have a lot of hope for that business, and I'd still invest in companies like that, especially if I do it through my fund, because that fund has been set up for the longer term and doesn't really depend on whether I'm going to be around or not to see a successful outcome.
So just a comment and a question from Jeff Calvert. As Mike, I see a lot of early stage companies, when they go through this process, it's a bit of a checkbox to do performance. But sometimes the numbers are irrationally exuberant because they believe great numbers will get investors excited. Do you see a downside to this approach?
Yeah, it's a credibility thing, Dave. Because if I see a forecast that shows I'll just pick a number, 50 million. If I see 50 million or higher, say after 5 years, assuming that there's revenue in year number one, first of all, I get very interested because I say, hey, this could be a unicorn. This could be another big home run. But then I say, how realistic is that? Are they dreaming? And then I go back and then it really comes down for me, especially to the marketing questions. And, it gets back to who are the customers? What are you selling to them? Is it possible? Are these numbers achievable? And then you factor in competition and all kinds of other things. So this is when you really start to tear apart a business plan and look at all of those factors. But it certainly does get your attention. Now, if it's too high, you might dismiss it. Like if somebody says they're going to be $1 billion in 5 years, you might think, well, they're just crazy. They just don't understand finance, and you might not even give them an audience. Now, the converse of that is if somebody, and I see this actually quite a bit, if somebody produces a plan that calls for $1 million or $2 million of revenue after several years, I say, look, this just isn't exciting. It's just not ambitious enough. May be great for you, may be a great personal lifestyle company, but it's not one that's going to get investor attention. And in fact, you probably don't want investors because they're going to keep bugging you for exits. They're going to hound you and say, well, when can we cash in? When can we get our money out? So, too low is not exciting, and too high, while it may get attention, really has to be justified.
Couple of other questions just before we close. One from Chung Kyatso. How would you react when you're caught off guard in a pro forma presentation to possible investors? What do you do? What's the best answer? Is it to just say, I can't answer that question right now? Or what do you do? What do you think?
Yeah, the best thing is honesty. I mean, if you don't know the answer, just say you don't know the answer. And there's nothing wrong with that. Like angel investors know that many entrepreneurs have a science or technical background and they're not financial or accounting geniuses. They understand that. You just have to come clean and admit it. And I think that's that actually serves you well, because it shows that you're not afraid of admitting some of your weaknesses. There's nothing wrong with saying, well, finance isn't my specialty, and I'm working hard at learning about accounting and cash flow and so on. But right now, I don't have an answer to your question, and I don't think you can do more than that. But for sure, don't BS, don't bluff or make something up. Just come clean and be honest.
So I'm going to go to one from Kyle. It says, a big part of my costs are and will be legal fees, some of them uncommon. How detailed should I itemize these costs? I suppose this question can be more general. For instance, your spreadsheet had furniture, but not chairs, tables, desks. I am a software patent company. I'd like to make sure I can explain to investors how I'm going to manage the costs I have, but without getting too granular.
I'm glad you asked that question, and I think you should be very granular. So you made the comment about, in my spreadsheet, I just showed under fixed assets, I showed furnishings and equipment, for example. Now, on that furnishings line, for example, that's going to consist of a lot of details. Like, what are those items of furniture? I should have a detailed list of those, right down to, desks and chairs and cabinets and so on. And again, the beauty of using spreadsheets that you build yourself is you can just insert as many details or lines and columns as you wish. So in your example with software and legal expenses, I would go as granular as you possibly can. Now, you may develop your own rule of thumb. So for example, one that I have when it comes to fixed assets is $1,000. If it's something that I can buy, like let's say a router that's $200, I might just expense that rather than calling it an asset. But if I'm buying computer equipment that's say $3,000, then I would capitalize that and keep it on my books as an asset. So, regardless of what business you're in, you can develop those rules of thumb and say, okay, we'll just lump some things like office supplies, for example. I wouldn't suggest that you have paper clips and staples as line items, but you might have, office supplies as one category, and you might know that, $25 a month is going to cover all your paper and staples and little things like that. So it's a judgment call as to where you draw the line, and really up to you where you do that. But generally speaking, I'd say go as granular as you can, because then you'll have a good, complete, thorough picture.
So I think that was our last question, but in addition to thanking Mike, I'm actually just going to send out two very quick polls. First one would be, would you be interested in developing pro forma financials that are specific to your company? Really trying to understand how many of you are with a company that's trying to do this right now and might like a little bit of assistance. So that's one of the polls. The second one is we're just going to ask people very quickly how you would describe yourself. Are you from a startup, a growth company, or maybe you're an advisor, mentor, or entrepreneur in residence? So just going to send out both polls just to get ourselves a little bit more data. And we'll see what everybody can give us in terms of a bit of feedback. It's interesting. Over 90% of people who are on the webinar are interested in working on a pro forma financial statement that is specific to their company. So it's very overwhelming interest in doing that.
Okay, so Dave.
Yeah.
So I'd like to just give you a link, give the audience a link for the template that I use, and it's one that I use frequently with many companies that I work with, and it just gives you a basis for really looking at what I've explained today. And it's difficult to talk about spreadsheets on a webinar. When I do this with entrepreneurs in person, we actually open up the Excel file and start putting numbers in it and play around with it. But I'd just like to give you the reference, and it's not there as we speak at this moment, but I will have that uploaded shortly, certainly before the end of today. And you can get it on my website, which is mikevolker.com. And then just do /mikevolker.com/finproj.xls. So that's FIN, fin for finance, finproj, PROJ.xls. And if you have trouble with that, there's also a link on my website that says presentations. And I will put today's presentation there. And I will include the link in the presentation. So even if you don't remember what I just said, all you have to do is remember the website and go there, which is mikevolker.com. And I'd be happy for anybody that uses it. Feel free to email me if you have any questions. And for that matter, if you come up with some of your own creative ideas on making it really work for you and useful to you, I'd love to hear about it. And finally, of course, if you have projections which look pretty exciting, and if you're looking for capital, my angel fund, What If, would be more than happy to hear your presentation.
All right. Well, Mike, thank you very much indeed. Really good audience today. Great participation from the companies that were online, and very, very good and valuable information. Once again, VentureLabs would really like to thank you for joining us. Very informative hour. I'll remind everybody that we have another webinar tomorrow at 10 a.m., which is looking at digital marketing for companies that are selling online, which is what a lot of people are doing these days. And I don't know if we'll have a virtual round of applause for Mike, but just before we sign off, I would like to thank everybody and hope to hear more about your companies in the future. Thank you very much.
Thank you.